South African investors are having to navigate tricky times given the low economic growth environment and political uncertainties. As a result, many South African retail investors are turning to fixed income funds which offer returns in the region of 9 to 10% without equity risk and with readily accessible liquidity. All fixed income funds have credit exposures, which makes this a critical topic we now need to discuss. At Ashburton Investments, we have dedicated credit portfolios and a credit risk management team constantly working on creating the right outcomes for our investors. We have prepared a short talk around the credits and the opportunities that are available for South African retail investors. Credit falls into two broad categories, being bonds and loans. Both are fixed income investments where we invest cash and expect to earn a contracted yield or return on that cash. Bonds are generally listed on the JSE and are freely tradable and are typically issued by government, state-owned companies or corporates. Government bonds are considered the least risky as they're backed by the full faith and ability of the government to make the required payments, whilst for corporate and state-owned companies we rely on an individual entity's ability and willingness to repay. Loans are private transactions negotiated directly between a lender and a borrower. This is a market dominated by the banking sector, although the investment community is slowly becoming a more integral part of this market. Although loans are not tradable, they are generally transferable between different lenders. Most likely you are. If you have an interest-bearing account or an interest-bearing investment, there will be some form of credit involved. Even if we consider a simple call account, this is equivalent to an overnight loan to your particular bank, which you roll on a daily basis, where we place our faith in that bank that the money will be repaid or be available for withdrawal when we need it. Common investments in credit include money market funds and income funds, where money market funds are low-risk funds with exposure to short-dated, very high-quality credit, primarily to banks. The next level up would be an income fund, which provides a high return but takes longer dated credit exposure and a high allocation to corporate credit. The risk of credit can be defined by credit rating, which is assigned by a rating agency. Where a credit rating is helpful is that it allows portfolio managers to quantify the probability that a company will default and therefore cause a capital loss in the portfolio. This is the key risk that any portfolio manager needs to assess when constructing portfolios. Ultimately, we need to determine this risk, make an informed decision as to whether we're getting an adequate return to compensate us for the probability of default that might exist. Most importantly, a rating is always just a guide, and it's critical to ensure that any credit investor has their own independent process that can verify or provide an alternate opinion to that of the rating agency. The recent sovereign downgrade, which has been extensively covered in the press, has had the effect that the credit risk of the South African sovereign has worsened relative to some of our large corporates. This creates an opportunity for fixed income funds to increase their allocation to corporate credit. The South African market is unique in a lot of ways. One of the primary features of the market is that it's primarily a bank lending or private market. So if we look at the structure of this market and we look at where corporates are borrowing, only 20% of money is borrowed through the listed market, meaning only 20% of money is borrowed through the issuance of bonds in the JSE, whilst 80% is still borrowed through banks. What that means is that it's important to consider all sources of credit when building portfolios, because in terms of what's issued on the JSE, there are only roughly 50 borrowers, while over 400 corporates are borrowing money through banking channels. This makes it very important to make sure that the person or company investing your money into this asset class understands both markets and has access to platforms that enable investment in both public and private markets to ensure optimally diversified portfolios. Ashburton Investments funds have unique access to the loans originated by RMB, and they form a useful source of corporate credit return for our fixed income funds. There are various options available for investing in credit here at Ashburton Investments. It's important to note that the access to the credit market largely depends on the risk profile that you would like to achieve for your investment. You can consider options ranging from a money market fund, which is our lowest risk investment, or moving towards our slightly higher risk profile, such as our two income funds, which both use bank and corporate credit. You can also access private credit through our credit co-investment funds, which are useful when used as diversifiers and as potential return enhancers to achieve the best risk-return profile for your credit investment.